Hello and welcome to the Baby Giants Investing Podcast. Join us as we chat about the weird and wild world of small cap investing, all while searching for the precious few fast-growing businesses that have a shot at becoming industry giants.
This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Podcast guests and their clients may maintain positions in the securities discussed in this podcast.
And we're live. Got a full house today. We're recording this on Halloween, so we might have a few spooky stock-related things to talk about later on. Andrew, have a think of some spooky stuff. I know Claude's got a few ready to go.
Okay. Yep.
Maybe we'll kick out and we'll cover a few small caps. Got plenty of small caps to talk about, kind of in quarterly season. So there's a bit of news coming through. And maybe to kick off a bit of good news, first malaria vaccine slashes early childhood mortality. So we finally have a widely available vaccine for malaria, obviously one of the terrible diseases, and it's decreased toddler deaths by 13% over 4 years. So I think that's a very cool stat, and a 22% reduction in severe malaria in kids young enough to receive a 3-shot series. So yeah, technology
that's
and
like
science
getting strong good news these days. Can't turn children living into bad news. It's like I'll get him this time.
Yeah, that's good. Cool. All right, let's go on. What should we talk about first, gents? Should we do some small cap stuff?
Yeah, let's do it. Which one?
I was looking at you. Should pick
Are
one.
you looking at me?
Yeah, one of the companies.
Well, let's do 8Common. 8Common is very small. We talked about this before. They do software for government agencies, travel management, expense management, that kind of thing. They had a quarterly result out. I thought it was pretty good. Record quarterly transaction and recurring SaaS revenue, 20% increases there. Cash receipts up 44%. So pretty good. The thing with this business is it's really tiny and it's dealing with government agencies and things are super, super, super lumpy. So on some things you saw like the cash flow receipts from customers down a little bit, but I think you can look through that. At least that's the hope in terms of it just being sort of the natural variability that you're going to get quarter to quarter on a company like this. They're getting pretty close to the line in terms of available cash, but I thought it was pretty cool. One of the directors, an executive chairman, in fact, fronted up $1.5 million at 6% interest so that they could sort of avoid what would have been a pretty dilutive capital raise. So
Just to clarify, by pretty cool, you mean you think the interest rate's pretty cool? The actual fact that it needs to borrow money off its director is less cool, right?
I'm more sanguine on that. I'm more of the, if there is money to be spent that's likely to get a good return, spend it like crazy and get it wherever you can. So they're at a point, I would argue, after a long period of sort of build out, that they've got some really good products, they've got really good take up, they've got really good opportunity. So that's the more pressing question to me. If you've got, and look, we've known that other small caps have had to raise money at much more onerous terms. And if they had to do a capital raise in the market, that would have been a very high cost of capital. So I'm on the presumption here that this is money that's going to deliver a good ROI and that's sort of going to build incrementally on already sort of sunk costs. Then yes, but you're right. If not, then yeah, better if you're entirely self-funded. But they're early stage companies. We've all started companies ourselves. We know what it's like. Money goes out the door day one, and you hope it comes back. And so yeah, the market didn't like it, but hardly any shares traded.
It's flat right now. But yeah, I don't want to come across as too against 8Common, but at the same time, it has been. My concern would be that it's just like not going to be like that higher margin business. So it has been listed for quite a long time. And yeah, it just seems like a really very slow march to cash flow break even, I guess. So on the upside, this is typically the weakest quarter is Q1. So if there was a time when there might be the worst look, like the trough of sentiment and stuff like that, that may well be right now. And if you look at the last couple of years, typically, Q4 has been the strongest cash flow quarter. So, I guess that would be one thing that would mean that you might be willing to just sort of overlook that this was a fairly weak quarter.
Yeah. I mean, and that they had an incredible fourth quarter. Like the revenue achieved, close to $3 million.
It was 3 million, just to give you numbers, mate, 3 million. And then now that's dropped down to 1.7. So like that's part of their, it would seem, just their cash receipt cycle. And I think they do have a lot of government customers. So that makes perfect sense. It's quite common to see businesses that are, tendering to government get paid in that Q4.
Yeah. And like compared to the previous corresponding period, it was a good lift. So, I mean, look, I don't think that this one result sort of signifies anything other than, compared to the PCP, things more or less moving in the right direction. If there is if we do not see a continued lift in, at least on trend in terms of revenue and all the important metrics, then sure. But I feel as though it's pretty well placed at this point in time. I've got a small holding on it. I'm happy with it. I'll continue to hold, but we'll see.
What do you guys think of director loans generally? So I guess that's kind of a situation where some small caps, particularly micro caps, are so small that if you have a director that's wealthy enough, they can loan money to the company. Maybe you avert a capital raise, I guess is the argument, and don't get diluted. So it could be better. Just curious, maybe your thoughts, particularly Claude, if you're a bit skeptical on it, what you think about director loans.
I think it depends on the individual director, to be honest, and their intentions. I definitely think that it is fair to say that if you do have director loans, you're definitely more at the mercy of the directors than otherwise. Like it gives them more power. Like they probably own shares themselves. They're on the board. They also, a creditor. These people are really, they're going to be very much in charge of not only hugely influential over the degree of success that the company has, but from that position, they're also going to have a ton of individual control over how the spoils are shared should there be success. So if there's a direct loan and, they also shareholders, like you need to be, it's very much a bet on this person wants to, have shareholders got wealthy as part of their legacy. Not all, people do to different degrees. I'll tell you, when you have those stories where shareholders have done enormously well, little, external shareholders, whether they be funds or individuals, you've always got a situation where that has been the intent, almost always got a situation where that has been the explicit intention of the people running the show.
Yeah, that makes sense.
What do you think, Matt?
Yeah, I think Claude summed it up really well, actually. Like it really depends. You're trusting the director more. I think if you've got a really aligned, if you kind of imagine like a founder-led business, that's kind of in a way what you'd want, right? So if it's like a lot of governance stuff. It's like you want a founder which has a lot of control if you really trust that founder and trust their judgment. And I think a lot of the rules that are set up around independence are designed for the lowest common denominator where you don't trust them. So the whole fact of it's another way that the director has more power, and as long as you trust the director, then they're doing something to benefit all shareholders. I think it can be really.
You've just given me an idea, Matt. It's like fellow Jean-Philippe Picard, Go for Growth Co. on Twitter. He has been doing this list of founder-led businesses. Now, having a look at it and just thinking about it, maybe think, I actually think it's interesting, by the way, the list, but at the same time, I think that you do need to sort of manually think about each scenario, because I actually disagree with the proposition in ASX small caps that founder-led is a good thing. Like, I would never start a scan like, oh, show me all the founder-led companies and I'm just going to look at those. I think that if anything, you wouldn't be creating any sort of advantage in that scan. Now, I do think if you say, I want to look at, companies with $1 billion in revenue and those are founder-led, then that would be more of a signal, because there's something about the business that has allowed one person to take it from tiny to huge. But actually, almost the most common thing, the ones that aren't, the micro caps and small caps that aren't founder-led or don't have a founder involvement, I'd say that might be a bit of a red flag, but mostly how one of these small businesses is going to get onto the market, it will be still have the involvement of its founder. They'll probably still have a big chunk of shares as well. That's kind of just the norm. And if anything, I wouldn't say that it really is a signal, because essentially, what it's going to come down to is it a good business? And then what is the mettle of that person? Like, are they just, some people, they run lifestyle companies on the ASX, they've got a story or a tenement or a drug or whatever it is that they're developing, and they have to go out and raise a couple of $1 million every year to keep the company going. And then at the end of the story, there might not be any, look at some of the technology companies that we've got, they're going to solve climate change through carbon capture, or one I invested in as a baby investor was ceramic fuel cells, which I made money off, but that went to zero, right? And all of these things, it goes nowhere, in the end. But along the way, some people got fat salaries and maybe even cashed out shares at a profit as well. Like, now, I dare not say the company's names, but the ones, like $1 billion market cap, zero revenue, and legions of adoring fans that are just bought in. It's like otherworldly stuff, right? So, the fact that there's a company that's telling a story of a super duper AI powered super duper doopy and has no revenues, the fact that that guy's founder is there, it's like, well, that doesn't mean anything, like,
Yeah.
so I just think that it's not a signal at the small cap end. For sure, if you get to like the big end of the world, these founder-led ones do tend to often have something like maybe they have the ability to grow without high capital intensity, and that's how the founder still has control because they didn't have to dilute so much, or they grew very quickly. So in one person's career, you could go from startup to, on top of the world or whatever it is.
Yeah, I agree completely, Claude. Actually, I had reached a similar conclusion recently, or over the last couple of years, because I think we all kind of came from that idea of like founder-led's good. And there is a lot of pros to a founder-led business, but I think you've captured it that it's way more signal for a large business to still be founder-led than a microcap. And the worst thing, well, the common thing you see is a microcap founder-led business that's been founder-led for the last 10 years and is still a microcap. And if it's the same leader over like a long period, it's possible that they're the reason that it's not getting bigger, like they're not leading it to success. You never want to own a microcap that stays a microcap, right? Like the point of it is to graduate and become bigger and become a giant. And I think that's something to weight, is that A, it's common, but B, it can actually be a negative signal if there's been a microcap founder who's still there for a long time, and not just market cap, but like is a revenue and cash flow trajectory going the right way.
Any microcap nerds interested should check out this company, Global Health. Just checked it then. I can remember literally when I sort of started more than 10 years ago, its share price was kind of more or less the same as what it is today. And it's just been going that whole time.
Same leader? Same founder?
I don't. The same founder was involved for a really long time. I, as you can imagine, stopped following this some time ago, so I couldn't actually tell you off the top of my head.
Yeah, just to complete the thought. So the difference when a very large company has the founder in charge, the founder then brings that same benefits that allowed it to grow large and kind of keeps that founder mentality and ownership culture and stuff that starts to get lost when a company grows large. But you should have those already in a small business.
Mate, you called it, by the way. The same guy that was either CEO or managing director when I looked at this like 10 years ago is still, according to their website, the managing director. So there you go.
You need something to change,
example.
Right? Like if it's not the management, something else needs to
needs
change
some sort of shift,
or something. Yeah.
Yeah, we've talked about it before too. It's also a very different skill set to start a company than to scale a company. And I think it'd be hard for a lot of founders who are used to sort of micromanaging, not in a bad way, but just because they've always had to be the cook and bottle washer and everything else that's involved, the chief marketing officer, the chief technology, like just everything inside the business, and delegating and having the trust and competency within the wider team to do that is tricky and really hard to let go. So it's not necessarily a nefarious kind of thing, but just maybe an ego kind of thing.
Exactly.
Yeah.
It's super hard. It's not like they're idiots because they haven't done anything in 10 years. Like it's just really hard. That's why it's so valuable to find businesses that can grow to be $1 billion business, Yeah, I think that, and I think that you develop a certain, like there's a skill set to surviving, frankly, like for 10 years. Like it's not a skill set we probably want to invest in, but like as Claude said, the ability to keep raising capital, you need to be able to raise capital and keep the ship together. And sometimes if there's a drug that they're working on, that can be like the catalyst. You do just need to do that. It is a lonely road, and I don't really invest much in biotech, but those that's the nature of it. But a lot of these other operating businesses, you want to see some more traction.
And I think too, one more thing to riff on there is that it reaches a point where it's not about the money, or it at least shouldn't be about the money, in the sense that you are so minted at this point and you're at a certain age, you're coming up to 60. You could go and live whatever lifestyle you wanted to live, just short of sort of Bezos and Musk level kind of wealth. Into like practically, what are you actually going to do with the $200 million net worth that you have? Like anything is the answer. I mentioned Mike Viverka actually from Jumbo recently. His founder started it, just on his Jumbo shares alone, it's like $150 million. We could mention our obligatory Pro Medicus and Sam Hupert, insanely wealthy individual, but the kind of person that still gets up and does it and works these long, stressful hours as a CEO of a listed company. That's a strong signal, right? Like it's like you're not here for the money. Clearly, you job done. You could get out today and make.
Yeah, I completely agree with that. There's a certain kind of person that like just loves work, what they do, and the impact they're having, or something like that. Like
you could make him retire. Yeah.
My dad always told me like, he wants to like work forever and never retire or whatever. I'm like, I don't know if that's still true, but like even as a kid, I thought that was absurd.
It's a special kind of person, that's for sure.
What else caught your eye, Andrew?
There's a few stuff that's sort of breaking at the moment, so I'm probably not going to talk about that. I will say this: good old Pointerra the company that's sort of gone from hero to zero. Well, from zero to hero to zero very quickly. And not exactly zero, but I'm speaking a little bit ahead of time here. Nice.
Some spooky sound effects there.
Actually, later today, I'm speaking to Ian Olsen. He's come back again to sort of explain himself. But don't let it hit you on the way out.
We didn't spend 90% of prep time on spooky noises.
Well, they had an enterprise sales update recently. It sort of spoke of some encouraging partnerships and commercial agreements, but were very vague and sort of fuzzy. Then we had the quarterly 4C literally out this morning, which I haven't had a chance to look at, other than to know that some of the metrics that they were sort of very keen to promote earlier still very much absent. So it's sort of like
I reckon most people listening know it already, but in case you're new to investing, just track the metrics a company reports. And you would be surprised how often the dropping or removal or changing of a metric coincides with bad times.
Yeah, it's just such an own goal here as well. So I'll give an update next week after we speak to Ian, give him the benefit of the doubt. But
nice.
that is also out on the wires today, as they say. What else have you guys seen? Alcidion, you want to chat on that?
Yeah.
Well, there's nothing much to say as we talk, because they've just gone into trading halt.
So they're going to raise some cash. We don't know why. And you were opining off air, Claude, that it looks unnecessary given their cash burn and the cash pile that they've got. So we're speculating it's probably an acquisition. Otherwise, why else would you do it at these levels? But we don't know. It's interesting.
By way of disclosure, I own Alcidion shares, and I'm not
too.
psyched that there's a capital raising, but hopefully it's for
Well,
a
it
good
depends.
reason.
Let's see. Maybe the most incredible acquisition. The NHS has just been acquired for $1.
That might not be a good thing.
No, maybe careful what you say.
And did you want to chat Iress integrated research? Did you still want to chat those ones, Andrew, or no?
I just thought, look, I don't have anything super insightful to say in terms of both integrated research and Iress. It's just that I saw Iress the other day and noticed that it's just been a train wreck, right? Of just in the last year alone, they've gone down 50%. And really between 2015 and 2023, before the drawdown, they went nowhere. What's interesting about Iress is that I remember back in the day, this was one of the real, it's just a great cash generation machine. They had a very, I thought, pretty decent moat. They had really good growth and margins there for a time. They're clearly doing something really right. And it's just, and same with integrated research, right? Like I feel as though, and I'd be curious if anyone has had a look at this. My instinct is to say here that they've been the mercy of a structural change happening both within their respective industries. In the case of integrated research, we're getting a lot of this diagnostic software being incorporated in the existing platforms that companies are using. They don't need their own in-house sort of monitoring as much anymore. There's more bundled with some of the bigger platforms, is my guess that's going on there. And with Iress, you're now having a situation where the only thing that really helped you there was that you had a captive audience and a very cozy oligopoly amongst sort of data providers. And that now that your customers, which are largely sort of brokers in the financial industry, have a few more options that are out there, and perhaps their margins are being squeezed, some of that pain is sort of rolling downhill. But both look as though, to me at this point, as though companies that are just well and truly post-growth. And I suspect there's been a few bargain hunters that have been psyched out by these, which have, again, traditionally companies that have delivered really good returns, really good growth, big fall on some disappointing news. Easy to say, well, it's just a bit of a blip. They'll fix it. Strategic review, now it's cheap. And I don't know if that's the case. And I'll just to quote some numbers, Iress is still on a PE of 19 after falling that much. And again, this hasn't grown in a long time in any meaningful way. Integrated research is a PE of 22. And they're not cheap multiples for companies, again, that aren't growing. Maybe growth will return, but geez, it shows you there's another way for PEs to sort of go up, even though share prices have come down.
You don't want that kind of PE expansion, man.
No.
When the earnings fall, it's trading over 50 times the earnings now.
So funny, I had, when we worked, Simply Wall Street, you get a lot of emails about companies just randomly in response to, the automated boom. And people sort of, we'd read them. And I just remember the number of people saying negative things about integrated research. Just I've never like it was an amazing like weird little signal. I'm like, sure enough, it's just done absolutely terrible.
I'm so glad I sold out when I did. I suffered a big loss on that, like percentage wise. And yeah, it's one of the ones I'm glad I got out of when I did, because it could have been worse.
Yeah, I never took it seriously after that, because I was like, I could never buy shares in this company. It's like we've put up this sort of like weird radio signal, and it's coming back like saying, from the ether, like avoid. Weird.
Oh man, I sold it at I sold some at 222 and 136.
Where is it today?
This is back in 2021. God, thank God for that. 33 cents.
Oh, done. Give yourself a pat on the back for that.
Yeah, that's a win. I'll take that. I mean, I did lose money.
Real money off this back in the day, 10 years ago.
It was a great company. It was a really brilliant, deeply moated, high retention, ultra scalable, capital light, high margin, like did everything that you want.
Correct me if I'm wrong, but wasn't it run by the same guy? Like it ran and the share price did pretty well, and then that CEO left, and he became the CEO of Appen, and also took Appen up like to very highs, and then back down a lot of the way. But like,
maybe
they both did these ups and downs.
Oh, that could be the case. Yeah, no, I'm not sure though.
Part of me is like, just next time you become CEO of a company, just buy some on punt and then just sell some like once it's tripled or whatever.
Yeah. He did pretty. Yeah, they were kind of. They weren't like. I mean, Appen obviously had years of growth that he was presided over, of course, before it came unstuck.
He should have just got out at the peak, and then he would have looked like a massive legend.
All right, let's do some. Should we do some Halloween themed stuff?
Yeah.
All right, gents. What's some spooky things that you see when you're researching stocks, or what's the spookiest thing you can come across when you're a small cap investor on the ASX?
The guy's changed his legal name.
Yes, I think I know of at least one famous example where that was the case.
I've seen it before. I can't remember now.
So that was Big Un. Big Un was the biggest one, right? Yeah.
That was the obvious one where it was like there was other red flags in that one, though. It wasn't just that he changed his name.
Well. He changed his name. Yeah, there was a lot going on there.
Amazing. Retiring to spend more time with family is always a red flag for me.
Yeah, it scares you a little bit.
Yeah, like no one leaves the party just as no one when you know that things, the culmination of years of work, you're about to
no one really wants to spend time with their family. That's what you're.
No one wants to spend time with their family, right? So that's odd to begin with that you would want to do that deliberately. You could understand it's like there's a health issue, or there's a better job offer, or there's something like that. It's just like it feels as though you need to give the market and investors a reason as to why you're leaving, and you don't have a good one. So you say, family? Like what? The workaholic CEO who's just spent the last 5 years working 90 hours a week all of a sudden has, just as the business is hitting its strides. I feel as though it's the same with politicians,
if you
right?
wanted to spend time with your family, you wouldn't become the CEO of a listed company in the first place.
It's never the reason. The reason is there's something going on behind the scenes.
Well, the board's not going to publish it if you're like, the CEO's quit because we've had complaints about his behavior at the Christmas party.
He's sniffing chairs or something, or God knows what, So that's a worry.
Going to allow it.
What about if there's no reason? Yeah, isn't that that's a bit almost spookier, right? When they're just like, that guy's gone, and they don't even say like spend time with family. It's like obviously it's not that, and that it's even worse because they're not mentioning.
Yeah, I don't know if I've ever seen not a reason. They'll always give a reason. Even if it's a really lame one.
I'll have to dig them out after this.
But that's the thing. The lamer the reason, the more I'm suspicious that there's something going on.
I don't find it that scary because to me, it's like the real reason might be like the CEO has made a lot of bags, and he now would like to indulge in his passion of like skiing and staying in 5-star resorts, and some of that will involve hanging out with his family. So rather than be like, Mr. CEO has resigned to lead a life of pure luxury and build on his Bordeaux collection, they just like, he's going to spend time with his family, as if like that's just the little white lie.
Yeah, these are heuristics. He's
actually going to like spend his time like getting drunk on red wine and going skiing or whatever.
You've got to also understand that the ego is a big driver for a lot of these people. Like it gets to a point again where it's more about, you might have the ability to sort of lead that lifestyle, but you still would want a bigger legacy, be it the boss of a bigger market cap company. I don't understate that too dramatically, I don't think. I think it gets to when you're in that world and you're in those circles, it very much becomes a certain measuring contest amongst your peers. And generally speak, if it was just about the money, a lot of these people at a certain size are pretty wealthy anyway. And if it was just, I just, want to go buy some more wine and do that. I don't know. I just, anyway, it's a heuristic. There's rules of thumb where it doesn't always apply, but I think more often than not, I'm a little bit skeptical when I see
the other one that's pretty popular is, they've sold shares to, buy a house or whatever, but it's like they've sold, they obviously have their house probably costs like $30 million or something. So it's like,
yeah, but I'll accept that.
It's like you're just shifting an investment, right? It's like you used to invest in the company. Now I invest in luxury real estate. Like,
look, I would actually appreciate that more.
We always talk about this one, but I'm going to buy a really big boat. I just love that. Marcus Blackmore.
Oh, Marcus Blackmore.
Yeah,
that was brilliant.
I'm really rich. I can buy a massive super yacht, and I would prefer that to these bits of paper.
Yes, I respect that.
David Dickers, I'm paraphrasing here, but it was like, I'm buying a personal jet, obviously spending more on my racing cars, and I'm going to punt on derivatives or something like that.
Yeah, I like it.
I'm going to be shorting the market, guys.
One of the spookiest, scariest words I see in small caps is commercializing. That scares me every time that I see it. And to me, it means like businessing, which I think I've talked about in here before. But like, we have an idea for a product, we're going to try and create it. And I just think it's like 90%, 99% of the time, it's like totally the wrong time to be listed as a business if you don't even have a commercial product. Yeah, that's probably one of my scary ones.
Commercializing. Yeah, it is a worry. It's sort of like, I mean, there are notable exemptions to that. One that initially comes to mind is Ordinate and their video product.
Commercializing a second product after a very successful first one, I guess, that's true. If you're bringing more products to market, that's great.
Yeah, I mean, look, these are all heuristics, but yeah, I totally get your point. I like the one that you mentioned before, Claude. I'll do it if you're not going. I'll steal it. Strategic review.
Oh, that's a spooky one.
No one reviews the strategy when things are going well.
Yeah, I think I've been insufficiently scared by this in the past, and I should be more scared by it in the future. Because what it basically means is like, we want to like sell the part of the business or sell the business, which sometimes can unlock some value, but at the same time, it also means like we don't even like the asset that we have.
Yeah,
so,
I mean, it means we're going to hire a bunch of consultants as well.
Yeah,
for the
you're
next
going to lose money.
6 months. You're going to lose a bunch of money on consultants. It means we don't know what to do with the business most of the time. Yeah, it can be sell, but it can.
That's terrible.
I'm putting it on the list of red flags, guys. It's an immediate thesis review with the potential to sell from now on. I'm not going to tolerate that anymore.
Any more, Claude? Any other spooky things you can see happen? What about a capital raise?
Can be. Capital raise for working capital needs, always a bit spooky. Here's any kind of suspension from trade, basically, except, rare circumstances where it makes sense.
Oh, there's a lot of good suspensions, though.
All right, let's be more specific. Suspension from trade for not having put in your, documents.
Oh, that's a horror. That's like a Texas Chainsaw Massacre. That's absolutely the absolute scariest. It's late on Friday, it's not even Friday. You don't
any
even know
announcement
until Monday.
after
It's
5
there's
p.m.
no
on a
Friday
Friday.
announcement. There's no Friday announcement on Monday. You wake up to a suspended stock because they haven't filed the. Yeah, that's definitely a low point in an investor's life if they own a stock that's happened to.
So in a former life, I inherited coverage of Yellow Brick Road Holdings.
Mm-hmm.
As you guys know. In fact, I think that may have been partially your fault, Andrew. But anyway, we'll take that up some other time.
wasn't my fault.
You went along with it. No, you were incapable of stopping it. Yeah, okay.
Yeah,
so, and one of the things I really noticed about that, because I had to back in those days, I'd cover every single company in our reports in the quarterlies, and there was a lot of small caps, and I'd always do Yellow Brick Load last, it's always the last one in. It comes out at 7 p.m. on the night. You're like, ah. Anyway, I think that in hindsight now, what I know now, I would have just wrote, based on their consistently always putting out their results last, it's a sell would have actually been, a good one. But I think I found reasons eventually, so that's nice.
Well, I mean, related, I guess, is a horror of a delisting. I feel like that would be the worst possible outcome almost, because you don't even.
Well, that's where Yellow Brick Road has ended up, right? It's just now it's getting taken over at more or less the lows by whatever group of people who are benefiting, but it just goes nowhere. I remember That can happen.
Especially when you blame the market for it as well. Like it is Burris's case, like the market doesn't get me. It's not my fault.
It's just like the most obviously like the worst. We should do a whole episode on this one company.
We could be like the opposite of the Acquired podcast. Could be like Sold or like just talking about.
Like there's another company, Scan Tech, as well. Like I'm sure there are at least 2 listeners that remember it somehow. It's like this is years ago. It was like my first experience of like some undervalued company getting like taken under, as it were.
Taken under.
It's like
what's Scantech do?
It was like some like conveyor belts that like scanned coal or something like that to check its water content. I can't even remember. I made like that was a wild punt about what they did.
Yeah.
So someone can correct me if they wish, but yeah, ultimately like this was my entree into the concept that, you know, one way things can play out is a company is undervalued because the market doesn't really trust that that it'll get paid out in dividends or whatever they need in order to push that share price up, and then in the end it gets some like taken over by existing shareholders at quite low prices. And it never did pay out like that value or whatever it was. Then they get it privately, and then presumably the dividends flow. I have no idea what happens after that.
Yeah, capital raising at like a 50% discount. That's always the worst. But yeah, trying to think of any other spooky ones for you, Andrew?
Trying to think. I mean, definitely Strategic Review is up there.
Strategic Review is a good one because it kind of it's like the stock's already down when it's happening usually, right? And it's just such a like, you're just like, oh, okay. Like, you know what I mean? Like if you've owned it, you're just like, oh, I guess that's good. And it's just like almost always not good. No good sign.
I mean, acquisitions generally make me a bit nervous. And we all know the stats that only 1 in 3 work out roughly. 1 in 3 sort of break at par, and the other third sort of loses value. So I think statistically you have to be nervous of acquisitions. I'm a big I want to believe kind of investor. Like I want to believe the story. Yes, that makes sense, and I will buy into the bullish narrative with the rationalization for a lot of these things. But that's a flaw. Like I shouldn't look at it that way, because very often they are corrosive to your capital.
Actually, I just got a question from a listener, Bryce, literally while we're recording. He said, I noticed commentary about Vmoto. From what I can tell, the risk is from international leadership in Australia. My question is about this company in contrast to Rectifier, which has, I guess, like international... I don't know about that, though. She's like, basically, what are the red flags about Vmoto compared to Rectifier, basically? And I think it's just where the operations are and where you sell, right? So Vmoto they're making scooters in, I think, like China and selling to China and other countries. And that's where like the operations are. Rectifier is an Australian company that operates in Victoria from memory. They sell to Australian company, another Australian company called Tritium, which actually is just in the news today. So this is a completely different set of risk. But I just noticed today there was an article in the AFR. Tritium asked Queensland government for up to $90 million bailout. So I would hope for Rectifier's sake that, Tritium stays in good shape, because from memory, they're a customer of Rectifier's. But yeah, no, I think Rectifier is a more or less Australian company in large part. So I don't think it's sort of similar to Vmoto, which operates in China. And you guys want to talk about Adore Beauty? Sorry, I got sidetracked. Yeah, so they're another one in the news lately. They've got their update out recently, and I think it's just the sort of same old story, really. The online retailers, they can get revenue, keeping in mind that, a lot of online businesses, by tweaking price or spending more on advertising, they can increase revenue. So what really matters more, I guess, in the long term is what margins are sustainable for them. Adore Beauty is saying that they're on track to receive an EBITDA margin of 2 to 4% in FY 2024. So I'd say that's probably, a key takeaway for anybody. Raymond wrote an article on this on our website, but I could think sort of the side point that he was making is that, these kind of only online businesses, they really do face competition, right? And we were discussing off the show, Andrew, you made that valid point. Like, if you're going to be an online seller of something, what you really need to maintain margins, and I think there are probably other ways to do this, but one way you can maintain margins is you're the exclusive distributor of something, right? And that means that you don't get stuck in this situation where it's all about who's willing to give up enough margin so that they like spend the ad on Google. If you look for something, all the first results are ads, right, from Google. So it's just this arbitrage on all these online retailers. And how do you build up some sort of competitive advantage? what's the old thing, you know, you need people to come directly to the website. And for all of these like random retailers of XYZ, there's some people that come directly to the website, but also you're still in a very competitive situation, especially if you want to grow. So if you've been advertising to maintain your sales and then you stop that advertising, you're going to go down, even if you get more profitable. So that's, I guess, where it lands with Adore Beauty. It's not really been one that I've sort of considered buying, but I don't know, Andrew, what do you think? Is there a kind of time when something like, you know, the Tim Tam, like I don't think Matt was saying off there, you know,
we were joking before, the Tim Tam thesis. So just thinking back to, you know, 2020, 2021, there was a lot of bull thesis about the stock. The stock's down, I don't know what it is, like 80% or something from those highs. And every time you read a bull thesis on it, it always mentioned that they provide a free Tim Tam in every box, and that was like a big part of their competitive differentiation. People loved opening the boxes because you get a free Tim Tam, which is cool, but it's like, I think it's like a classic Buffett standing on tippy toes thing. Like it's pretty easy for other people to copy that. And I think, I guess my framing, I'll hand it over to Andrew, I know he's looked at it, is for these businesses, I think you're spot on. Like it comes down to, can you avoid the Google tax, or how much you can avoid the Google tax? And I think you mentioned one way is having unique products, which you can only get from Adore or only get from the online retailer rather than reselling everyone else's. And I guess the other is just through some other habit or some other reason, people go to you directly instead of searching Google for the product. I think it's all about that. That's what really counts. You just need direct organic traffic for whatever reason. I think there can be other ones, like Webjet's one that's always impressed me better than I first realized, is how much that created a habit with people where they don't go to Skyscanner or direct to the website. They're happy to use Webjet, and I know you get a few other things with it, but I think that they've done really well at building a brand that gets organic traffic and used a lot of non-Google advertising as part of their strategy, etc., to own that mind share of, when I go to search, my habit is I type Webjet instead of doing something else. And that's what you need for whatever you're selling. Like it's not very easy to do, but that's what you need to do.
Yeah, it's just really, I'm just always mindful with these kinds of businesses. Any moat is extraordinarily difficult to build and even more difficult to sustain. So it's sort of like when it's done exceptionally well, it can be wonderful. But it's just, you're only you're one miscalculation away from a really bad result. And yeah, retail in general, every time I've dipped my toe into retail, I've not done well. And every now and again, I get suckered in by a value proposition. It's like, yeah, it's pretty crappy, but wow, look how cheap it is. I don't know. I think I've finally learned the lesson on that. Just stay the hell away from retail. It's just too hard. And with the added challenges of being a pure online player.
Some nasty guy had a go at me because I was like sort of bearish retail and Harvey Norman in particular. And it's like, this is a hard place to play. Like Jerry Harvey's out there years ago.
Was it Jerry Harvey, Claude? Was
it
Jerry Harvey that had a go?
No, it wasn't. At least if Jerry Harvey had a crack at me, I've been like, oh, you know, that's nice, but it's just some boring nobody. So you're like, oh, great. I just subjected myself to some abuse out of the goodness of my heart. But yeah, no, like the point is that this is not an easy place to play. Like you're trying to play some like, you know, hardcore value investor thing. Oh, the dividend yield's 10%. Okay, but you got to buy it. You got to get your little re-rate when magically things look better for a little while and then sell it. Because look at Harvey Norman. Like, yeah, if you bought the bottom and sold the top, you made a good little return on as the share price gyrates. But long term, you're on a ticket to nowhere. Like, and so I think a lot of these, because retail is competitive, right? Your margin is somebody else's opportunity. It is one of those ones where, yes, you could probably make money in retail and maybe Adore Beauty, and actually, but there are more attractive ones, right, as well. Like, so, you know, think one that we've had a laugh at before is like Dust Group as well. But like these look potentially cheap. What's the other ones that sometimes catches the eye? Shaver Shop Group. These are little cheap retailers that you sort of come across when you look at scans. If you're, you know, looking on sort of low P kind of scans. Yeah, some of these are interesting, but it's like, it's just it does come across to me as a sort of hard and more treacherous place to play because it's just the way they tend to go up and down. The exception being the one that I have made money off, I don't know if it counts as retail, but is Capilano Honey back in the day. But that had a whole thing around the fact that like honey supply was getting tighter because of weather changes to climate and weather, and also an awareness that honey from certain places was not really safe to eat. And so that basically Australia had a competitive advantage because it at that stage didn't have the Varroa mite, which has actually recently arrived. Because of the competitive advantage you can basically make more money essentially, and they had it pinned down the supply in Australia. So that was a kind of separate thesis from your normal retail thesis. Mind you, I think there are some retailers that are strangely good businesses like Lovisa. So I wouldn't want to throw out the whole industry or anything. It's just I do also agree, and I find it quite hard.
Yeah, it's tricky. The last one I dabbled with was Adairs, and I bit the bullet on that just around $2 or so again. So I didn't cover myself in glory there at all, but it was nice to finally sort of recognize that. Just another reminder, right? Like selling is such a distinct skill from buying. And I've said many times it's one that I really need to improve upon. But you got to celebrate the victories when you do get it right? Because it is very difficult to walk away, particularly when you've got a value thesis and the value only improves by virtue of the share price getting cheaper and cheaper. It's like, well, I was wrong before, but now surely I'm right, unless there's a material change in what you're expecting to sort of happen. But yeah, retail is just super tricky.
Yeah. I've definitely dabbled before, but I just can't remember any big successes. I think that I made the same kind of venture into Adairs, mate, at some point, but I don't think I did particularly well out of it.
I mean, you look at things like JB Hi-Fi, right? Like that's an incredible success story. Nick Scali, another incredible business, right? I do wonder, and this is just a thought bubble more than anything, but I do think both companies have been run exceptionally well by exceptionally competent retailers. But I do wonder to what extent was right place, right time for those models and for an environment where we just had incredible offerings and deflations in all electronic goods. And we had a housing boom that would make any developed market weep, and, lots of people with lots of equity wanting to renovate and redo and zhuzh up their homes. I wonder if in a different environment, would have they done well? Probably. But how much success was due to that macro sort of tailwind?
I wonder if the skill involved in making Nick Scali a success was actually really quite high. Like, they really needed to get that product market fit. You want the, I guess, decent amount of money to spend. Baby boomers waltzing in mindshare, off to Nick Scali to get a new leather sofa or whatever. I think that's quite hard to get right. The JB Hi-Fi thing, I agree. There's just been a big tailwind for that, right? When JB Hi-Fi started, there just weren't as many devices that we used, or it wasn't.
Well, where are you going to go? Dick Smith's? Come on.
Yeah. But the other thing is JB Hi-Fi has the real world and online equivalent of that mind share. You're like, oh, I've got to get a guitar table or whatever. You just one of the first places you would check, especially if you want something now, would be your local JB Hi-Fi. And then if you buy things online, you still might consider JB Hi-Fi because it's not got the reputation of being a super expensive alternative. You could possibly get it a bit cheaper on Amazon though.
Plus, they did their staff training really well. You can walk into most JB Hi-Fis and get someone there who's going to help you out quite a bit, and particularly people of a certain generation who really like that kind of stuff, a bit of hand holding, a bit of expertise. They've really nailed that component of it, and I think that's another sort of thing that they've done incredibly well. They've also evolved and adapted very well too. I remember 10 years, 15 years ago, I was quite negative on it because they had a significant part of their money was selling DVDs and CDs and that. And it's seriously, who's going to buy that? Well, they survived that and thrived. And
and it was cheap because of that worry, right?
Yes. Yep.
I'm sure
completely
I had
read that wrong. Completely read that wrong, but they just leaned into the other electronic products, and we've seen how wonderful that has been for them.
And that was a baby that we kind of all missed. Although to be fair, it's kind of before my time.
Well, and it's also, there is something to be said for when you've got that critical mass, you've got that traction where, okay, we've got the model, we know the model is appealing, we know it works, we know the unit economics are sound. Oh, and there's another 400 locations in our local market that can be exploited. That is an incredibly strong runway and setup, as opposed to perhaps where it is now. It's every single Westfield and Main Street we are in. So it's
exactly.
What?
And also we just had
rollout's a huge part of a retail.
Rollout is yep.
And we also just had really good conditions for all retail when people couldn't go out and eat and party and travel as much, but they could still buy stuff.
I was just going to Amazon basically as the other time it kind of got a bit cheaper when Amazon entered, but it seems to have seen it off pretty well so far. I guess Amazon was way worse when it initially launched than I was expecting. A lot of people were expecting. Although I think now, I don't know, it's a hard one for me because I'm like a Amazon Prime member, and my default is Amazon for most purchases. Like if Amazon is almost always cheaper or thereabouts, and it saves, like, I don't have to spend any time searching basically. So there's like a certain bar for different products, a certain price where I'm just like, yeah, I'll just buy it on Amazon, and I get free shipping. It shows up like the next day to my house. I don't need to go to a mall and fight my way around. So for me, I'm not the reference case though, I guess, because a lot of people still like going to the malls. Yeah, I don't know. Just kind of curious your thoughts on that for some, when we think about retail, like that's been the behemoth in the US. That's eaten. I think Amazon now has like 50% share of all online electronics or something, or over 50%.
Yeah, I think what they've done there is they have made sure that it's not just the range and availability of stuff. It's also the full customer experience of getting it super quickly. And I think they've understood that very well. And I think that they've reinvested any margin in lower prices as exceptionally well. I mean, it's a axiomatic these days. The Bezos, your margin is my opportunity kind of thing. And they have religiously sort of gone after that. Think about the difficulty in competing with that. Kogan is the obvious example, right? Like, I don't think they stand a chance. Even if they understood to their very core exactly what it is that's special. Do you have the access to capital to build out the necessary
it's so wild
infrastructure?
That Kogan shares was at $20.
Oh, it's 22 almost. Yeah.
What is it?
21 almost. It's 440.
$4.45.
Yeah.
And it still doesn't even have a PE ratio, right? It's like, is it even profitable?
No, it's just, I mean, it's a wonder in a world where Amazon didn't exist. It's probably launching overseas and becoming Amazon itself, right? Ruslan, hats off, buddy. Well done. It was a really cool story.
I mean, he's made tons out of it though, right? He has. He gets paid a lot, like.
Yep, but it was there are certain centralizing, any network effect kind of business is going to have a very almost unassailable lead once you hit a certain scale. And I think you get to a point where it's sort of like, there's nothing you can do. In 10 years' time, I'm not even sure Kogan exists.
Yeah, because Amazon gets you with streaming as well, right? Like you pay for stream, like you get Prime and you get a free video streaming, which is like,
and music.
I watch a lot of stuff on Prime, actually. Like it's probably my main subscription thing if I'm watching something these days. I'm a nerd. I watch a lot of documentaries and stuff. But yeah, so like, and then you get free shipping as well. Like, I don't know. It's very hard to compete with. Plus it's so integrated with everything else you do. So yeah, anyway, we don't need to rattle off on Kogan again, but I do think they will really struggle just because they're now bringing global scale to it. It's not even just like if it was in the old days, Kogan might be able to defend because it has local scale, and that's kind of what matters most of the time, right?
Yep.
But Amazon's global scale, it's amortizing its cost of content. It spends billions and billions of dollars on content. It's amortizing that across the whole globe. So Kogan can't go out and start a video streaming service. Obviously, that'd be like absurd. So yeah, it's a not a great position compared.
And investments they make in markets where they do have a bigger foothold can be rolled out here. I mean, just look at an Amazon warehouse is just a symphony of technology, right? And that it's just even someone with a bigger presence in the local market is going to struggle to compete on those kinds of fronts. I mean, is Kogan going to have the same kind of robotic technology? The same, I don't know.
Shipping, like I think I think everyone will be as sold on Amazon as I am once they start 1 hour shipping.
Yes,
that's what they have in the US in a lot of cities. 1 hour shipping, and you can
that's
easily do
impressive.
it in Australia, in Sydney, Melbourne, and hopefully Brisbane. I think that you could easily do that.
What about Canberra, mate?
Oh yeah, Canberra will get it. Yeah.
You can ride around Canberra in an hour.
Yeah. They'll all ride bicycles in Canberra.
They should. If you're listening, anyone from Amazon, please start in Canberra.
But yeah, everyone talks about Australia being like very spread out population, whatever, dispersed. But actually, we've got everyone's concentrated into a few big cities. So you hit like half the population with like 3 cities, 4 cities.
Yeah.
I love that now our ragging on Kogan is like on brand as well, because it is a small cap.
Mm-hmm. That's an ancient Halloween curse. May you be a small cap. Yes.
Yeah.
Okay, cool. Any other last thoughts?
Just on that, and it's not to put the boot into it too much, but just to finish off the thought, I think it is, and this is why you've got to be, the red flags are always when the consultants come in. Nothing says clearer, I fundamentally misunderstand the nature of the business I operate, than I'm hiring a consultant, right? Like nothing says it. And I would have imagined, maybe this is easier with a bit of benefit of hindsight, but I imagine that the whole Kogan thing initially, the secret sauce there really was that we're just going to do generic TVs and electronics made from parts. It's going to be almost as good, but not as good. And that's cool. We all know that. It's just going to be dirt cheap. And that's what we do. You amassed enough of an audience that you felt, well, actually now we can do phone plans and we can do this. And I get someone drawing a line to that, but I think it's a failure of recognizing the core competency and value prop as it was, and then to assume that could be replicated in domains where you really didn't have any other. You were just essentially a reseller, and you had a bit of a captured audience and a bit of a loyalty there. But in any other way, like, it just wasn't there. And we know how quickly those things can erode. But if they probably just stuck to their knitting with that, they might still have a more viable model. I don't know. Maybe they'd also be a lot smaller as well. So what do I know?
Yep. No, very good point. All right. Well, should we wrap it there, gents?
I've got one last spooky sign I just thought of. It's when, like, the managing director's remuneration gets changed from being shares to cash.
Yes.
I don't want these.
No, it's not. It's so as not to dilute the shareholders, man.
It's so long term. Yeah. Oh man, that is spooky. All right, thanks very much for everyone for listening, and hit us up on @BabyGiantsPod. It won't be Halloween when you're listening to this, but we had some fun, and look forward to chatting again next week.
Cheers.
Thanks everyone.